I think there's been two things that have really driven the trend to more people pursuing index and ETF-based strategies in the way that they invest. And this is true for both the institutional investor and retail investors. The first is the fact that investors today are able to access beta very, very cheaply through innovative ETF products, innovative index products. That means, in effect, that the hurdle that one has to get over in order to generate active returns has gone up. In other words, it's not that the bar has gotten higher at some level, it's that the entire floor of the stadium has gotten lower. So that's put pressure on active strategies. Secondly, and importantly, we've been in the last several years an environment where policy changes by central banks, whether it's the Fed, the BOJ, or the ECB, has really driven asset returns. We've been in a very low interest rate environment, and in that environment, it's really the tide that raises and lowers all boats that's more important than individual security selection. I think both of those trends will reverse over time. First of all, on the second trend, we will have reflation. We will have a return to a degree of volatility that should allow active managers, regardless of asset class, to be able to generate returns. Secondly, I also believe that the industry is innovating on the active side as well, finding ways to produce alpha for clients at a more competitive cost, thereby bringing that bar down the same way that the bar has come down for index and ETF and related strategies. So I do believe that we will see a return to active management, and that strategy will be increasingly important for investors to generate the long-term returns that are required to meet their objectives.